Hello. Good afternoon, good evening, good morning, to you, ladies and gentlemen. It's your Sir Jerry Mtumkulu. In this video, we are pursuing our learning objectives for week number 9. To those who are studying with us at Transcal Business School or Transcal Consulting Services. Okay. In the previous videos, we covered the group statement of financial position, which was actually quite um, a larger part of the lecture or of the week's task. In this video, I'm going just to um, discuss the tiny bits related to the group statement of profit or loss and other comprehensive income. So we'll discuss about those related facts, as you have already seen that whenever another company whenever a company buys another company, okay, there is need to prepare consolidated financial statements. So the same principles which were applied when we were preparing the group statement of financial position are also going to apply in this uh, in this area where we'll be looking at the group statement of profit or loss. Okay, so you mustn't be intimidated. This is just the same stuff which you are now accustomed to. Okay, now, as with the statement of um, financial position, the group statement of financial position, the aim of the consolidated statement of profit or loss is to show the results of the group as if it were a single entity. That's the idea. Okay. So we'll use the same principles as we applied for the statement of financial position, and the idea will be to show the total profits made by the group, and then the extent to which these profits are owned by the parent company and non-controlling interest. So for us to actually be able to grasp what we are talking about, we just need to go through an example to see what we mean. Okay, there is this particular example um, where we have got a company Pico which acquired 80% of the share capital of S on that company's incorporation in 2008. So this parent company acquired this other company on the date when the other company was incorporated. So there are no previous retained earnings. The pre-acquisition retained earnings, they are not there, and it was just acquired on date of inception, on date of birth. Okay, so the respective statements of profit or loss of the two companies for the year ended 31st December 20x9 are as follows. Okay, so these are um, the performance. Okay, so this company was just acquired in the same year in which it was incorporated. Okay. We've got the revenue, the cost of sales, the gross profit, expenses, profit before taxation, income tax, and then profit after taxation, the profit for the year. Then the movement in retained earnings, we've got retained earnings brought forward, okay, and then retained earnings for the year, and then retained earnings carried forward. All right. Okay, so given these facts, I want you to see something here. Okay, uh, this subsidiary S was acquired in 2008. Okay, and then uh, we have got the statements of profit or loss for the two companies for the year ended 2009. Okay, which means although the subsidiary was acquired at inception, that is when there were no pre-acquisition retained earnings, uh, we are now seeing that after 2 years, that is at the end of the year 2009, uh, there are now some retained earnings. Because somebody might be wondering if the, the company was acquired at inception trading, without trading history, how come we have got retained earnings brought forward? All right, this should be for 2008. Okay, this for 2008, and this one is for 2009. Okay, this one's 2009, this one's 2008. Okay, that's the information we have at the moment, and we are required to prepare the consolidated statement of profit or loss and the movement on the retained earnings for the P group. That's the requirement which we have to satisfy. So what happens, ladies and gentlemen, in our group consolidated statement of profit or loss? We are going to use the same principles. If we have identified that this one is a subsidiary, then we are going to do a line by line consolidation. So what we are going to do is the group SPL is going to be made up of the figures as follows. First, the revenue of the group, we are going to say 52,000 plus 24,000, and we should get the value there. Okay, 52,000 plus 24,000, that's 76,000. And then for the cost of sales, we're going to do the same. 12,000 plus 10,000, we're going to have 22,000. Okay, and our gross profit, the gross profit is going to be 54,000, which is almost this one plus that one. And the expenses, we are going to follow the same technique. Okay, for the expenses, we are still going to follow the same technique. We are looking at 12,000. All right, this one was also in bracket. All right, and here we get 42,000, and then for the income tax, we are also going to add. This is 15,000, and we get our the remainder there is 27,000. Okay, this is the profit for the year for the group, and now we need to do the appropriations now to see what the non-controlling interest get and what the parent company gets. So we then have to need some space. We need some space now. We say profit. We continue and say profit attributable. Excuse me. Attributable to. We start at the top there. We put owners of the parent. Owners of the parent company. Owners of the parent, and this is a balancing figure. This should be a balancing figure. And then non-controlling interest. Non-controlling interest. This one now is based on what we are given by the examiners. Okay, we are based the non-controlling interest on their reported earnings. Okay, we give them based on the subsidiaries reported earnings. So the non-controlling interest, remember this was an 8% subsidiary, so the NCI automatically is 20%. So therefore, they are going to get 20% of the subsidiaries profit for the year. So that's 20% of 7,000. 20% of 7,000, and that should be somewhere around 1,400. Okay, so we said that for the parent, that's a excuse me, that's a balancing figure. So what we know is the total profit for the year. The total profit for the year, according to our computation there, was 27,000. The group's total profit for the year was 27,000. So we know that this total should be 27,000. Okay, so therefore the difference should be the balancing figure here, and that is found by 27,000 minus 1,400, and we get our 25,600. Okay, and then we do the same for the if we had the other section for the other comprehensive income, we're supposed to do the same. Other comprehensive income attributable to the owners of the parent, the non-controlling interest, and we continue like that. But at this level, we are going to end at the profit attributable to section, and we are done. Okay, the other part of the question, the other requirement was to discuss the movement. Okay, to prepare the movement on retained earnings. So we can do that. It's not a big deal. So movement, just to have enough space. Okay, movement in retained earnings. Okay, the movement in retained earnings. We have got the retained earnings brought forward. Okay, retained earnings BD, that is brought forward. The retained earnings brought forward, we have got our retained earnings for the group. Okay, the retained earnings for the group, the retained earnings brought forward were 80,000 for the parent. So we're going to say this should be opening bracket 80,000 plus, okay, the 8,000 plus, this was an 8% subsidiary, so that's plus 80%. 80% multiplied by the previous retained earnings, the retained earnings that was brought forward by the subsidiary, and this is 20,000. Okay, that's 20,000. We are going to take everything because when we acquired this subsidiary, it had zero retained earnings. Therefore, whatever retained earnings they now have is going to be taken as a whole according to the our shareholding. Okay, it is an 8% shareholding, so we are going to take the whole 80% of the 20,000. Okay, so if we do the mathematics, you can see that we end up having a total of, because 80% of 20,000, that's 16,000 plus 80,000, that's 96,000. Okay, and is this pen visible? I hope it is visible. I hope you guys are seeing something there. Then we've got the group profit for the year. Group profit. Profit for the year. The group profit for the year. This one, we determined it as here. Okay, that was the profit for the group that was attributable to the owners of the parent. This was 25,600. Okay, and then if we total up, we get 121,600. So this is the retained earnings carried forward. Okay, retained earnings carried forward. That's the movement, ladies and gentlemen. Just learn to practice it, and you discover that it is not going to be as confusing as it looks. Okay, let's proceed to the next example to see if we can do better. Okay, as you have seen, this in this particular example, we had acquired a subsidiary at inception, and then we were now doing the consolidated statement of statement of profit or loss 2 years later, and this is why we took the whole 8% of 20,000. But you discover that in reality there could be some pre acquisition profits when we purchased a subsidiary. Okay, so let us look at that situation. Okay, this example is concerned with the Pico, which is acquired 60% of the equity share capital of S on 1 January 20x8, at which date the retained earnings of S stood at 8,000. Okay, the respective statement of profit or loss for the two companies for the year ended 31st December 2010 are as follows. So you can see the two statements of profit or loss for the two companies. Then we've got a movement in retained earnings here. Okay, this is the movement. We are going to discuss about this movement shortly. Then prepare the consolidated statement of profit or loss, and the movement on the retained earnings of the P group. So as usual, we do the line by line consolidation. So the group SPL is going to be having, the revenue of 85,000 plus 31,000. That is, we get a total of 116,000. And then cost of sales 21,000 plus 12,000, we're going to get 33,000. Underline, we get our gross profit, and this is in bracket. So our gross profit is going to be 83,000. Then we have to less expenses. We add here again, and the expenses are 19,000. And we get the profit before tax. The profit before tax should be 64,000. And then we have to add taxation, that is 20,000. And we get, we subtract taxation and we get 44,000 as our profit for the year for the group. Then we open that section for the appropriations. So profit for the year attributable to owners of the parent, this is a balancing figure as usual. Then non-controlling interest. The non-controlling interest, this is a 60% subsidiary, therefore NCI is 40%. Okay, NCI is 40%, so that's 40% multiplied by the result of the subsidiary, the result of the subsidiary's profit or loss was showing that they made profit for the year of 8,000. So we are going to use that 40% of 8,000, and this should be 3.2. So that's 3,200. So obviously our profit for the year was the profit for the year for the whole group, according to our computation, was 44,000. Okay, this figure 44,000. Therefore the balancing figure should be the profit attributable to the owners of the parent, that is 40,800. Okay, we are done with that part. Then let's discuss about the movements in the retained earnings. Movements in retained earnings. Okay, the movement in retained earnings, we have got the retained earnings brought forward, retained earnings PT. We have got the retained earnings of the group. Okay, retained earnings of the group as given in the question. These were 120,000 plus 60%. Remember, this is a 60% subsidiary. Okay, 60% subsidiary multiplied by the retained earnings brought forward of the subsidiary. Okay, the subsidiary had retained earnings brought forward of 17,000. However, we had purchased this subsidiary when it was having retained earnings already of 8,000. So therefore we have to remove those pre-acquisition retained earnings from the 17,000, because the 17,000 includes those 8,000. So that's 17,000 minus 8,000, and we should get our amount as 40,000. I mean, not 4,000. This calculator of mine. Okay, this should be 125,400. 125,400, and then we have to add the group profit for the year. Which we have calculated there, 40,800, and we get the retained earnings carried forward. This is 166,200. This is retained earnings carried forward. Okay, now let's discuss about the impact of intra-group trading. Okay, because we need to consider those ones as well. They are also important issues which we need to grapple with. Okay, now just as with the consolidated statement of financial position, the consolidated income statement should show the results of the group as if it was a single entity. So when when one of the company in the group sells goods to another company in the group, then the sales will have been included in the revenue of the selling company, and an identical amount will have been included in the cost of sales of the other company. So in the eyes of the group, nothing has actually happened. Okay, nothing has would have happened. Okay, nothing would have actually happened. So uh, we need to do the necessary computations to actually present the accounts in a true and fair view. Okay, because when companies trade within themselves, nothing of economic value would have actually happened. Okay. Um, in the consolidated statement of profit or loss, the figure for sales revenue should represent sales to the outsiders, and the figure for cost of sales should represent purchases from the outsiders. Okay, and not from within the group. So we need to do the consolidation procedures to see to reflect that uh, only transactions with outsiders are being reported. Okay, so I'm sure you still remember from the previous video on the group statement of financial position that if any goods sold at a profit within the group are still in inventory, then the unrealized profit needs to be excluded from the group profit. We will achieve this, that is to reduce the group profit by increasing the cost of sales for the group by the amount of the unrealized profit in inventory. Okay, so remember the double entry we were dealing so far, we were only dealing with the one side of the double entry where we were just crediting inventory. We in the previous video on group statement of financial position, the unrealized profit was having a tendency of um, reducing the value of inventory. So we were crediting inventory, but the debit should be debit cost of sales. Okay, when we are debiting cost of sales with the unrealized profit, we are increasing the cost of sales. Okay, and at the same time reducing the profit. Okay, so we need to increase the cost of sales with the unrealized profit. By so doing, we will be trying to eliminate the impact of the unrealized profit. So let's take a look at example to come and see if we are getting somewhere. All right, we have to move. Okay, let's look at this example. P acquired 55% of S on 1 June 2028. The statement of profit or loss for the two companies for the year ended 31st May 2029 are as follows. So we have got the revenue for the parent and revenue for the subsidiary, cost of sales, gross profit, expenses, profit before tax, income tax, profit for the year. During the year, S sold goods to P for 20,000, including markup of 40%. One quarter of these goods remained in P's inventory at the year end. Okay, so here there are two things we need to worry about. We need to cancel out the sales, okay, because they are not considered sales when one company which is under the same control is, I mean, when companies under the same control are trading with one another, such sales are not real sales, so they have to be cancelled out. So the cost of sales, the respective cost of sales should be cancelled out. The respective sales should be cancelled out. Also, the unrealized profit within the group should be cancelled out. Okay, how do we cancel this unrealized profit? We know the double entry. Okay, the double entry is very simple, as we have just indicated. To cancel out the unrealized profit, we have to debit cost of sales and credit inventory. So the inventory is in the statement of financial position, whereas the cost of sales is in the statement of profit or loss. Okay, that's the double entry we are talking about, ladies and gentlemen. So by debiting cost of sales, we are going to see our cost of sales increasing. So what then happens here is that for the consolidation, the group statement, group statement of profit or loss. Okay, in the exam, you are not going to write this on the question paper and you're going to write everything. You are going to copy everything. As you can see, you are going to copy this part. You're going to copy, but here now, you then have to put, because you then have to say, for example, for the revenue, you're going to say 120,000 plus 110,000, and then minus, okay, because we are told that there were sales of 20,000 from the subsidiary to the parent, so these ones are not sales to the outsiders. Those are not sales, okay. They are not sales. All right, so we remove them. All right, and we get the figure to the group. Okay, we get the figure to the group. All right, so for convenience, I'm just doing all these workings using the figures that are already there. Okay, I'm just using the figures that are already there. So we're going to say plus that one minus 28,000, and we get 202,000. Okay, now for the cost of sales, this one is a bit complex. We're going to say plus this one minus the 28,000. Okay, minus again the unrealized profit. Let us calculate the unrealized profit. Unrealized profit. Unrealized profit. We can call this one working number one. Okay, we are told that these goods were sold at a markup of 40%. So, and the 20,000 was the selling price. So obviously, okay, we need to say sales price. Okay, sales price 28,000. This included a markup of 40%, so this one is 140%. Obviously, the cost of sales, the cost of these goods were 100%. Okay, the cost of the goods was 100%. So obviously, the profit is 40%. The profit. Now, to determine the profit in figures, you simply have to say 40%. Sorry. You simply have to say 40 over 140 multiplied by 28,000, and I'm sure you get this one is 0, 0, 14 into 28. Obviously it's 2. Okay, 0, 0. All right, so 2,000 multiplied by 4, that comes to 8,000. Okay. All right, someone might be worried, why did I say 40 over 140 instead of 40 over 100? Look, this is simple mathematics, direct proportion, those mathematics. We are simply saying if 140% is equal to 28,000, 40% is equal to what? Obviously, 40% is equal to what? Obviously 40% should be 40% should be 40 over 140 multiplied by 28,000, and you come to this conclusion there. Again, you do the same thing and say if 140% is equal to 28,000, what is 100%? If you want to calculate the cost of sales, then 100%, this 100% is going to be the cost of sales. So for 100 over 140 multiplied by 28,000, and obviously you're going to get 20,000. So you then have to know which figures do we want. Obviously we didn't want the cost of sales. We could have even ignored the cost of sales. Okay, for now what we need here is the unrealized profit figure, the 8,000. So we are going to pick that figure and slot it here, minus 8,000. Okay, so 55,000 plus 50,000 minus 28,000 minus 8,000, we are going to get 79,000. If we underline, we get our gross profit, and the gross profit is 123,000. So this one now is tricky. If you simply just get lazy and start to just play around with these figures as we did in the initial examples, you're going to fail, because here this example involves a quite number of adjustments. So you do not have to be lazy. Accountants are not lazy people. For the expenses, there are no adjustments. You just have to say 9,000 plus 10,000 and you get your 19,000. You deduct them from gross profit and you get your profit before tax. Okay, and this should be 104. Okay, 123 minus 19, that's 104,000. And then you have to deduct the total of income tax. 20,000 plus 14,000, that's 34,000. Okay, if you deduct, you get your resultant profit for the year of 70,000. This is the profit for the year. Sorry. Oh, excuse me. I was talking to my son. Okay. Now this is the profit for the year, the 70,000. That's the profit for the year for the group. Then you have to do that last part for the appropriations, where we say that you then have to extend. Remember, let's assume that this information is not there. Okay, you then have to say you continue and say, after the profit for the year, after this part, you then have to say profits attributable to okay, the profit attributable to owners of the parent, and we say this one is the balancing fig, and then to NCI, profit attributable to NCI. And remember, this was a 55% subsidiary, therefore for the NCI, we start with the NCI. The NCI, we say 55% of their profit for the year. Okay, so that's 55%. 55% multiplied by 36,000. All right, but now I want you to watch out there. This 36,000 requires some adjustment because there was some provision for unrealized profit. Remember, in this case, as we have indicated in the lecture on intra-group sales, in that video on group statement of financial position, the group statement of financial position video, we indicated that when the subsidiary sells goods to the parent, and part of those goods are still in inventory, there is need to calculate unrealized profit, the provision for unrealized profit, and this is going to impact on the NCI as well as on the group retained earnings. Okay, but if the parent sells goods to the subsidiary, then only the retained earnings, only the parent is affected. In this case, the subsidiary sold goods to the parent, and therefore the NCI is going to be affected. So this is why we are also deducting the 2000 portion. Okay, this is going to be moderated by the 55%. Okay, but it's not 55%. I'm sorry, there it's should be 45%. I'm sorry there. Let me just correct that. Where is the eraser? Okay, the eraser is this one. Okay, this is, sorry there, 45%. Okay, because the NCI constitutes 45%. All right, so the ultimate figure there, the ultimate figure should be let me calculate this, 15,300. So that's 15,300. Okay, and we know that the group profit for the year adds up to 70,000. I mean the group profit for the year. So therefore, the balancing figure should be attributable to the owners of the parent. That's 70,000 minus 15,300. We are going to get 54,700. Okay, so I hope this is enough for us to be able to work out, to play around, to maneuver the workings required when it comes to group statement of profit or loss for our Acca financial accounting upcoming examinations. Okay, if you feel like there is need for some additional flesh, or there is need for further coaching, please do not hesitate to contact me. I'll always be there for you, ladies and gentlemen, so that we work together. And these are my numbers. Please get in touch with me anytime, any day. 263-774-596-368. My name is Gerald. Okay, until next time, may you please continue to feel very excited, very excited. I am signing out.